Hey guys, Mike here. So I'll tell you what, we got a loaded week this week. And I mean, when it comes to earnings, especially economic data from Tuesday through Thursday, I mean, it is unbelievable how long and how much economic data is coming out. But especially, what do we got? CPI. And this will be probably the most interesting we've seen in a long time because of the new calculations, the new weights that have been put on certain things. And so who knows what this is going to do, but I'll show you the projection and stuff on that. And then we'll go in a couple of the charts. But one thing I wanted to show you today was, I've been meaning to put this out there for a while. It's been busy weeks, and I didn't want the videos to try to be too long. But is something understanding if you got in the market after '08 or especially 2020, right? You're probably under this kind of like belief that markets cannot go up when Fed funds rates are a certain level or when they're going up, and when financial conditions are tightening, markets can't go up. When the unemployment rate's going up, especially really high, markets can't go up. Well, I'm going to go ahead and show you something and let you understand all of that is totally false. I mean, it's 100% false. And I'm going to show you data literally, and it's not going to take long, all the way from the 40s going forward on all of this stuff and let you know. And it's probably going to shock you, actually, because, I mean, when I do this research, I don't know until I do it what I'm going to find. And some of it actually even surprised me. And I look at this stuff all the time, right? But some of the gains in the stock market actually come at the absolute possible worst times, when unemployment is through the roof, when the Fed funds rate is just starting to skyrocket, when financial conditions are really tightening sometimes. And so you got to understand that is possible, okay? And so we'll get into that real quick, and then we'll get into all the economic stuff. But here, I want to start you out with this right here. And so what we have here is you got the dark blue is Chicago Fed financial conditions, right? When it's moving up, it's tightening. When it's moving down, it's loosening. The light blue is going to end up being your QQQ, right? And then the orange is the Fed funds rate. Well, you'll notice right here, the dot-com bubble actually happened when the financial conditions were actually tightening. The Fed funds rate was between 4.5% and 5.5%. All right, and you can see we end up having a freaking bubble end up going up and, of course, bursting. But it went up during all of that. Okay, so that is absolutely possible. Here you can see after the dot-com bubble, what do you got going on, right? You got the Fed funds rate skyrocketing from 2004 to 2007. You got financial conditions basically trading sideways, somewhat tightening, but definitely not loosening there. And then the QQQ is actually steadily just going up, right? Because it had been recovering since '03. And so it's just going up. And you can see when the Fed funds rate at that point in time, I believe it was 6%, 6.5%, it's going up. Right? And even when you see, look right here, financial conditions are tightening dramatically, and the QQQs continue to rise, right? There's a huge lag effect in this, how this takes place. But it's still happening, right? You move forward. We'll go to 2014, 15, and 16. Those kind of interesting years there. And you can see Qs are just steadily going up, right? Financial conditions are tightening from June of 2014. And then the Fed funds rate is basically staying steady, which we'll talk about that more in just a second, right? Because this one they held it down. Then you got 2018, right? Fed funds rates, when they were raising this up, they were running the balance sheet off. Financial conditions, and these moves don't look big, but they actually are, because when you put three things on one chart, it doesn't look huge, but they are. And you can see, as they were raising that Fed funds rate, the QQQ, which is the most sensitive to those things, were going up. We had a 3 months crash down, and then they froze the rates, and then boom. It ends up skyrocketing like 30% in 3.5 months, right? And so, again, they can move when financial conditions are supposedly tightening and the Fed funds rate is hard. Now, unemployment, which is a huge topic now. So I went in all the way back to the 40s and let you see this. Look at when you get the biggest moves in the market. Look at this. Unemployment is coming down, and the market's actually coming down or trading sideways right there, right? Unemployment goes up to 8%. And the market is just skyrocketing. Those are huge moves. This is the S&P is the orange this time, not the Qs, okay? Blue line is unemployment. All right, you come over here where we end up going up 6%. Look what the market's doing as unemployment's going up that much. It's going up. I mean, by huge percentages, it's going up, right? Look what happens when unemployment's trading sideways, just kind of going up and down sometimes. Just in a range-bound stock market. But all of a sudden, unemployment skyrockets. Look what the market does. That is an enormous move in the S&P right there. Enormous, okay? And so you can see it is very possible, as you can see throughout our history here, even back in the 40s before algos took over in the 50s and 60s, look what's happening there. Unemployment's kind of all over the place. Market actually traded down. Unemployment skyrockets from like 4 to 7%. And look at that. Market just absolutely takes off. No problem. Even in the 60s. And now we're going to get in the time frame of the 70s where we had very high inflation, right? And this is when, yeah, the Volcker moment's come a little later than this. But look what happens. Unemployment goes to 8.5%, almost doubles. And what's the market do? The market actually starts to go up, right? It's amazing. But you can see when it traded sideways, the market was going down, right? And pause that if you need to. Then we get up here into the 80s and stuff. Man, look how much unemployment went up. Went up to 11%. This was the Volcker times where he raised interest rates to 20%. And you can see it got unemployment all the way up to 11%. But again, you know, what's the market do? This is the S&P, not the Qs, by the way. It's going up as unemployment is actually rising. And so then we go to the financial crisis. What happens? We end up going to 10% unemployment. What is the market doing? Right? It goes up. It skyrockets when it goes up. It's just amazing to see. And one thing I want you to look at real close when I'm talking here, it's not about the unemployment rate going up. What the market's looking forward to, remember 6 to 9 months, whatever you want to think, forward thinking, it's wanting to see what happens when it comes down. You can see what happens. It goes up, and then look when it goes into turbocharge. As soon as unemployment starts to come down, and you see them finally cross, that right there to me is a picture worth 1,000 words right there. You see that? The market wants to look at the same way as inflation right now. It's looking ahead to say, okay, what's the trend? Is it coming down or still going up? We'll play our bets that it's going to come down, and then when that happens, you see jet fuel added to the market. And 2020 is the best occurrence of this. Look at this. We shut down the world for crying out loud, and the market still went up. And yes, I know this is fueled by a lot of government spending. And so hopefully you can see what I'm talking about. I say the unemployment rate has a different effect on the market than what people, might think it does. Hopefully you can see it right there going all the way back to the 40s, guys, before algos and options and all this other crazy mess, before the government hijacked the stock market, which I'm getting into now, right? You can see that. You can see plain as day. What used to happen was, even when the Fed funds rate was going up, when financial conditions were restricting, the market still went up, right? It still was able to go up. I understand pre-08 especially, probably even for the dot-com bubble, fundamentals really meant something, right? The stock, people talk about you got to buy stocks that actually have, great balance sheets and all that stuff, and that really was the main thing that really drove stuff, right? And then 08 happened, and the financial crisis happened, and this is where the government stepped in. Right, this is where, and I'll show you, the Treasury decided, hey, we're going to be the biggest buyers of bonds and mortgage-backed securities from here forward, right? And then the government stepped in and said, we're going to run crazy budget deficits, right, to start flooding the market with money, basically. Right? We're going to start putting all these government contracts out, employing a boatload of people, start hiring like crazy. And so this is where this happens, and I'll show you if you just give me about 60 seconds of your time, you can see here's the Fed's balance sheet. Look at this, going from the dot-com bubble, going up a little bit. Look what happens after 08 right here. Look at this skyrocket up. Boom. We're going to step in and be the biggest buyer of mortgage-backed securities and bonds. That will allow more people to do what? Buy stocks. This is when TINA started becoming a thing. There is no other alternative. They drove yields down. Our savings account, CDs, all that stuff got absolutely hardly any kind of rates or yields on them whatsoever. And then you can see at 2020, that was just an absolute crazy time, because then they really put on the steroids and started buying like crazy, okay? And then here is the government debt, right? In 2000, they started running big. This was the last time we had a balanced budget, was 2000. They started running deficits, but then after 08, see these blips? These are huge increases. You can't really tell it on the scale. These are talking about trillions of dollars. And then, boom, look at that. Just rocketed up. Look at that big increase. That was like $9 trillion pump into the economy right there. And so you can see, what's the stock market doing? It's following it exactly, identically, right? When they cut, the market goes down. Same thing with the Fed and stuff. And so they just took it over and started owning it. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit that like and think about sharing the video, guys. And so hopefully the number one thing you got out of that was the stock market is not the economy, okay? Remember, the stock market, in my words, you can call it what you want to call it, ain't nothing but a casino. It's nothing but ones and zeros in a computer. We're typing in stuff. You don't even get a certificate anymore. You just get an email saying you bought this stock or an option or whatever you bought, right? And so that's what that is. But hopefully you can see throughout history, going all the way back to the 40s, the stock market can go way up when unemployment goes way up too. The stock market can go up when the Fed funds rate is being increased, and when it's high, the stock market can go up when financial conditions are tightening, okay? And even in the 70s, if you didn't notice that, in the 70s we had like 18% inflation, and then the unemployment rate was extremely high, and the Fed funds rate at one point in time was 20%, and the stock market found a way to still go up, right? Now, it crashed and burned at some point in time, but it still finds a way to have these huge moves that can extend for a long period of time. So understand that. I'm just saying it happens, right? It's hard to wrap your head around sometimes. I get it. And understand also that you will never see balanced budgets in this country again. Nobody will talk about it. You will never see small government again. Those days are gone. There's a reason why people don't run on that stuff anymore, because it's impossible to have it anymore. Okay, so get that out of your head. That's never going to happen. It can't happen. The economy would implode if we actually had a balanced budget, because the only way that would happen is how? Two things, right? Business 101, they're going to need to bring in more revenue through taxes, which that's not going to happen, right? Or they're going to have to cut spending, which they're going to have to cut Social Security, Medicare to the bone. If that happens, that'll be a catastrophe. All right, but hey, we'll see, right? There's a reason why we spend on defense a total of 9 times, a total of what the next 9 countries spend on defense. It ain't to make the country safer. Don't let them fool you into that mess, okay? It's high-paying jobs and a lot of other reasons. Do your research on that. It's amazing if you actually look into it, okay? So hopefully you got something out of that one. So now let's go into this week, and the reason why I showed you that stuff was what's happening now in the market, right? That big debate that's happening now in the market with the rally we see in, or what's going to happen this year, what's going to happen in 2024. And I'm showing the possibilities why certain things can happen, okay? That's what you're supposed to get from that. Now, looking at the S&P, look at the chart. Obviously, we're just back in this ascending triangle, as you can see. But I'm telling you now, the biggest thing, this is what the CPI report is going to do to us. It's going to push us in one direction or the other. We're either going to 4,300. I'm not saying right away. I'm saying that's where we're heading, though, and that was the August highs, or around 3,900, right, which you will get a nice support there as well. So, big swing either way. But again, this is going to be based off, to me, the CPI data and no other kind of data out there. And one stock I'm going to bring up, and I'll bring up the rest tomorrow, but it was interesting. When you go on the weekly chart of Meta, you can see this trend line goes all the way back to 2013, right? Bounced off of it multiple times. And when I was looking at it, I thought, oh, that's interesting. I was kind of wondering why it rejected where it rejected at. And you can see what happened. It rejected right off that trend line, right there. Boom. And so this is something to keep in mind, because obviously for it to keep moving higher, it has to get above that trend line, right? But that's a huge resistance. So keep an eye on that. It's a good spot to, look to trade it if you're trading it, or to get in and out of it. So, that's a big one. And looking on the smaller time frames, the only question people have is this gap going to fill? That will still be like a 13 to 15% drop, I believe, or not. Again, short term, it's oversold, probably looking for a bounce maybe. But longer term time frames, you can definitely see in it feeling. But CPI data, again, will have something to do with this. If it comes in red hot, or even better than what people expected. Now, here we got plenty of earnings, right? Monday morning, don't see anything that's going to really do anything. Monday afternoon, Palantir is pretty popular. The solar stocks have been basically very volatile. They were on fire. Now they're kind of all over the place. Tuesday, Coca-Cola, Cleveland Cliffs, Peabody Energy, Marriott International. We're still traveling like crazy, right? That's going to be something to look at. Devon Energy, Airbnb, another travel stock. Upstart. I hope that one don't perform like the other, buy now, pay later stock did. That got destroyed on earnings. Might be one to play. TripAdvisor, we still traveling. I mean, I got friends out of town right now going to the Super Bowl, right? Suncor is another one to look at. Roblox is a popular one. It's kind of been trading in a range. The Trade Desk, Kraft Heinz will be more about us, right? Are we still shopping? And what they're doing with prices is what I want to know. Shopify, Roku, a lot of people are shorting Rokus. We'll see how that one goes. Shopify's been on fire. And they had a decent pullback here recently. Then we're going to end up going with Datadog's been a pretty popular one for a lot of people they've been buying into. Crocs, it seems to, I don't know how, but a lot of people are buying those shoes, so it seems to always do pretty dang well. DraftKings, I want to hear, yes, are we gambling? Because remember, in Vegas, they report like a record for 2022. STEM is a popular one. Redfin, how is the market looking? Because that stock has been crushed as far as the housing market. And then John Deere is going to tell us what's going on in the construction industry, housing industry. It might have something to say about that too. And then here we go with economic data. Like this one's a big one, right? Monday, not much, but guess what? FOMC speakers are going to be rolling out a lot this week. Tuesday, NFIB Small Business Index, CPI month over month, CPI year over year, core CPI month over month, and 3 Fed speakers that day. Yeah, I wonder what they got to say. Right? Wednesday, core retail sales, Empire State Manufacturing, retail sales month over month. NAHB housing market index, crude oil inventories, because oil's been a hot topic here lately. And then, of course, Thursday we'll have core PPI, and then PPI month over month. This is a loaded day right here, man. Philly Fed Manufacturing Index, unemployment claims, building permits, housing starts, mortgage delinquencies, natural gas, FOMC speaker. Let me get a breath real quick. Whew. And then Friday, another FOMC speaker, the same guy that spoke on Monday. I do love how they speak multiple days. Now, here is what people are expecting, right? Another nice drop from 6.5, which was December. So now they're looking at 6.2 in most of the big firms, and then Bank of America said 6.1. So another, anywhere from 0.3 to 0.4 drop. And the thing to watch out for is this is what you need to look. If yields go up, they already broke out that this is the 10-year. I already broke out of this wedge right here. And so you can see if the CPI comes in hot, you can guarantee yields will most likely end up going up. If not, then this will be a false breakout. And so, like I said, it is a loaded week this week. It will be an extremely volatile week. We'll have to see how all the data comes in. Let me know in the comments what you think about CPI. What do you think? 6.1, 6.2, again, with all these different weights and formulas and stuff like that. Who knows what it's going to come out at. But again, we'll have to see. I think that's just going to dictate the whole week, right? And so I'll end up letting everybody know what the weekly range is expected to be, what the daily ranges are. And we'll go from there, okay? So hopefully you got some out of it. Hit the like, subscribe if you did. And I'll see you guys tomorrow.